Hey everybody, welcome to a video on open market operations. This is going to be an overview video for a principles course. I'm not going to get into any of the heavy technical aspects of it, but I think it should help to make sense of some of this stuff. So I'm going to answer the who, what, where, when, and why of open market operations. So let's start with the who. Who is involved? Well, who would be the central bank. In the United States, that central bank is the Federal Reserve Bank. Now, where do the decisions come from? They come from the Board of Governors of the Federal Reserve. And these Board of Governors, when we talk about open market operations, are usually targeting a specific federal funds rate. Now, if you don't remember what a federal funds rate is, that's the rate at which banks can loan money to each other in overnight loans. It's something the Federal Reserve can target. It's not our only way of controlling the money supply, but it's one of our common ones. And then there's a Federal Open Market Committee, or FOMC. This is the group that actually carries out the policy. Open market operations are a tool that we use to reach a target interest rate. And we do it by buying or selling financial securities. And most commonly, the weapon of choice for the Federal Reserve is to buy and sell treasury bonds, short-term government debt. Why do we use this? It's a safe asset. It's one that gets traded in money market funds. It's one that banks often have on their balance sheets. It's safe money. And so what does it look like if we're buying? Well, if we buy some of these, there's the Fed, there's the banks. Let's look at their interactions. The Federal Reserve buys bonds from the banks. The bonds go from the banks to the Fed, and in return, the Fed sends money. This injects money into the banks. Money leaves the Fed and comes into our economy. This will actually increase our money supply. And let me explain a little bit of why. Bank reserves will go up. Then the money multiplier is going to kick in, and the money supply is going to go up. At which point, we will also predict that the federal funds rate will go down. So if the Fed buys a bunch of bonds and injects a bunch of money into the economy, the federal funds rate should fall. And then selling bonds is all of that in reverse. Here's the Fed and the banks. The Fed sells bonds to the banks, and in return, the banks send money to the Fed. This money leaves the economy. It leaves the banks, reserves fall, money supply falls, and the federal funds rate goes up. This is the mechanics of open market operations. You buy bonds to increase the money supply and decrease interest rates. You sell bonds to decrease the money supply and increase interest rates. And it all has to do with whether money is leaving the Fed and entering the economy, or whether the money is leaving the economy and getting disappeared into the Fed. So, let's talk about where this happens. Well, this one I kind of didn't have a good answer for, so I just wrote financial markets. That's all. When does this happen? Well, let me give you a warning, my friends. I'm about to give major spoilers for a monetary policy chapter. I hope you forgive me. But in a recessionary gap, so when your economy is underperforming, the Federal Reserve will generally buy bonds, increase the money supply, and decrease the federal funds rate. In an inflationary gap, it'll do the opposite. It'll sell bonds, reduce the money supply, and increase the federal funds rate. Now, why does it do all this? That's the big question. Why would you want to affect interest rates during the different parts of the business cycle? Well, the federal funds rate is a benchmark for other interest rates. If the federal funds rate goes down, other rates go down. Consumption will go up as interest rates fall. Investment will go up as interest rates fall. GDP will go up, which means unemployment will go down. It also might mean inflation goes up. So buying bonds and reducing the federal funds rate can actually help our economy to expand. On the other hand, if we sell bonds and push the federal funds rate up, other rates go up, consumption and investment both fall, GDP will fall, unemployment will rise, and inflation might fall. Our federal funds rate can push us to different points in the business cycle. And so when we get to monetary policy, where their goal is stabilization and finding a balance between unemployment and inflation, this gets to be very important. All this buying and selling of bonds is used to stabilize our economy. That's all for later. It's going to be fun stuff, you guys, as I almost swear. So, how do they do this? Well, they just create money. If the Federal Reserve is buying bonds in this picture, where does that money come from? Well, we have a fiat currency, and so it doesn't actually have to come from anywhere. They just say, hey, here's $1 billion, and the banks say, thanks, here's some bonds. If they say the money exists, it does. Most of it's electronic. Technically, they can print bills too, but when they do this stuff, it's usually just electronic. So they create the money when they want to, because they're in charge of it. And they can remove money just by selling bonds, and they just absorb it into the system. Okay, a couple of questions we can ask. One, what is a liquidity trap? Well, let's draw a money market here. We'll have a quantity of money, we'll have interest rates, we'll have a money demand curve, and here's a money supply. And then the Federal Reserve buys a bunch of bonds, increasing the money supply. When they do, the supply goes up, the interest rate goes down. Okay, that's what monetary policy is supposed to do if they're buying bonds. But what if they try to buy a bunch more and increase the supply further? The interest rate might not change by much, or at all. You can imagine if I kept doing this on a graph like this, the decreases in the interest rate would get smaller and smaller. That's the liquidity trap. We also call it a zero lower bound, which is that the interest rates cannot go negative. There's some point where they bottom out. So, well, next question. Monetary policy is all about targeting interest rates. Does the zero lower bound eliminate the efficacy of open market operations? Does it make it so it's not effective anymore? It can, really. But there might be some ways for us to try to get around it. For instance, the Fed can buy more than just short-term treasuries. They can buy long-term debt, which will push down long-term interest rates, which might do something besides just pushing down short-term interest rates. Another option is they can buy other kinds of assets. Although the Fed traditionally buys government debt, it can also buy other stuff. One example, after the 2008 crisis, all those mortgage-backed securities we talked about in class that all the banks were afraid of because they weren't sure how useful and valuable they were. Well, the Fed bought tons of those, trillions of dollars worth. And that was another use of open market operations, where they bought something besides treasury bills. They hit the zero lower bound, but they thought that buying these might help problems also, because it also increased the money supply. It also made banks less at risk for going insolvent. There's a whole discussion to be had there. This video is long enough, so I'm not going to get into it here. But we call this process quantitative easing, when the Fed starts buying a wider range of assets to try to circumvent the zero lower bound. Did quantitative easing work? Some say no, because it did not stop the economic contraction. The economy kept getting worse and worse for a full year after quantitative easing started, and then we had a really slow recovery. Some say yes, because the contraction would have been much, much worse, they say. And without a time machine, it's hard for us to know. But there are smart people on both sides who say it could have been either way. Now, did quantitative easing cause inflation? I just talked about them buying trillions of dollars of stuff, just huge increases in the money supply. Did that cause inflation? Well, here we are a decade later in the year 2020, and the answer is not yet. No real signs of massive increases in inflation. So, there's your overview of open market operations. I just want to show you this picture again, because whether we are in this situation or this situation, the actions of the Federal Reserve have impact on us all. When they buy a few things from banks, it affects money supply, interest rates, and by interest rates it affects consumption, investment, GDP, the business cycle, unemployment, and inflation. The Federal Reserve has immense power to affect our business cycle. And, well, that's why it's important to learn a bit about how they work. I hope it was helpful for you guys. Thanks for watching. Good luck either way, and happy econing.